This is like a countdown to chaos, something that's going to send shockwaves throughout the world's economies. I'm going to explain why that shockwave might be felt everywhere and why it will come from China. Now, for some context, over the past 45 years, China's been on this epic journey, transforming from mainly farming into the economic giant that we know today. Many see China as the world's wonder economy. It's the engine the entire globe counts on for growth. And guess what? It's hitting the brakes. And as you can imagine, that's going to shake things up. Biden's been pretty vocal, calling China a ticking time bomb. And if that doesn't raise any eyebrows, he added, "When bad folks have problems, they do bad things." Now here's a twist. Biden mentioned that China's growth rate is down to 2%, but actually it grew by 5.5% in the first half of 2023. Sounds impressive, right? Especially when you compare it to the US, which only grew by 2.2%. So why is everybody worked up about China's 5.5% growth? Because relative to their past booming rates, I'm talking like double digits, 10, 11, 12, 15% back in 2007, it's a dramatic slowdown. And you might be thinking, I'm not in China, why should I care? Well, here's the deal. China's right on the US's tail as the world's second biggest economy. When China booms, the ripple effect boosts the global economy. That's thanks to their massive manufacturing hub. I mean, what's not made in China these days? But when China stumbles, the world feels it. Case in point, China reports a hiccup in growth and boom, the US stock market begins to wobble. Investors got jittery, wondering what's next, and some even hit the sell button on their stocks. So I want to show you this graph right here. You think, if imports are coming down, and in China's case, exports, what does this have any correlation to the stock market? Well, from a demand perspective, it's a huge correlation, as you can see here. So this is imports of goods and services against the Wilshire 500 price index, shown in red. And this is a year-over-year rate of change. And what I want you to see here is that the stock market generally gets it right. As global trade eventually slows, it reverses direction and heads down. And then when it feels it's slumping down at the bottom, the stock market rallies ahead of it. It's a pretty decent relationship. I mean, there are some times when the stock market gets it wrong, but nonetheless, it gets it right where it counts. And that's as global trade slows. Eventually, you can see growth of the stock market then outright contract. You see here during the dot-com implosion, and then of course again during the financial crisis. Of course, the market, as we know, led the contraction of imports. You started to see it during the pandemic, and now you see a case where the actual stock market believes the economy is actually better than it is. You can see that imports are contracting, and based on what we know, it's likely to continue. It's an anomaly here, at least in the beginning half of the year. And now perhaps in the last couple of weeks, the market thinks that the economy probably isn't in such great shape after all. And if this chart sticks to its pattern, the market is going to go down and just continue to go down. China warnings flash across global markets as growth disappoints. We've been seeing data revised lower and lower. Recent data suggests domestic product growth this year will be closer to the government's target, about 5% now, contrary to expectations of a large overshoot formed earlier this year. So if you think about China, their normal growth rate is closer to 8%, which is what their target is. So you say, well, wait a minute, how could 5% be a recession? So right now, the global economy is going to be somewhat reliant, or perhaps completely reliant, on the services sector to pull up the entire world's manufacturing sector. If indeed the manufacturing sector starts to lay off, it's game over. You're not going to find a bunch of people in the manufacturing sector go pick up low-wage service jobs. And if they did, they're still not going to have the spending power that they used to have. And that's why you start to see this go to hell in a handbasket. Eventually you see the services sector start to follow the manufacturing sector. In the crisis-ridden property market, sales are slowing after an initial rebound. Combined with the persistent financial troubles of real estate developers, that's hampering new projects in a sector which accounts for 20% of China's GDP after including related sectors. Infrastructure sector spending is being constrained by hefty loads of debt of local governments, symbolized this week by an 11th hour bond repayment by a state-owned firm. So again, what do we see? Signs of a slowdown in real estate, and again, too much debt. All these are problems. All of these are signs of what you see going into a recession. There was a lot of expectation that you would see a strong year in China, as everyone was betting that the Chinese recovery was going to drive the world's economy even better. And what we're seeing now is a fairly weak China recovery in terms of industrial production. We haven't seen domestic consumption really come through, and exports, which is a huge issue, have been a problem because exports out of the world's biggest exporter, the #1 exporter, slowed down. And what does it tell you what's going on with the global economy? It tells you everything you need to know that it is indeed slowing down. And there's further validation here right out of the commodity sector. Metal market faces grueling summer as Chinese demand falters, weakening construction activity to hit copper and iron ore. Again, great leading indicators right out of the commodity sector here. Big conferences crystallize the prevailing sentiment in markets, so it's probably no coincidence that copper has dived below $8,000 a ton and iron ore is trading south of $100 after metal luminaries gathered in Hong Kong and Singapore to chew over the perilous state of global demand and China's recovery. So, China's slowing down. It's been going on for months and it's getting worse. Definitely in recession territory, particularly exports slow down. We see the commodity sector validating this, and we're now getting the hint of demand problems. We keep seeing it in the US, and I've talked about it before. On the flip side, we did have the retail sales report come out on Tuesday, and it was double expectations. So at least there's some good news on the home front, but will it be enough to keep us afloat? Okay, let's break down the real estate issue. The real estate market is like a massive Ponzi scheme. Here's the thing, when you've got the economy based on a lot of debt and an economy starts slowing down, it's bad news. China's feeling it right now with their debt and slowing growth. But here's the kicker, the US is on the same track, just a few steps behind. Fast forward a few months and we could be singing the same sad song. Now, President Xi's been talking up his Belt Road Initiative, but some folks are calling it a debt trap because they're lending so much to developing places. Here's where things get tricky. When you pile a ton of debt and you mix it in with inflation, but then slow down the economy, you're not making enough fresh money to cover all that debt. And boom, things start unraveling. China's housing market, it looks like it's on the edge of a meltdown. Biden pointed to sluggish growth and high unemployment in the nation. But here's the real issue. Globally, we got aging populations. They're going to need support, and who's going to pay for that, especially when the jobs get slashed during a recession? Governments are deep in debt from the pandemic, and now they're drowning in promises that they made years ago for retirement perks. Even though Biden's stats on China were way off, like 2% versus 8%, the big picture is still gloomy. Think about it. China, the global exporting king, is slowing down. Less demand from the outside, and get this, their own people are buying less too. Big red flag for their housing market. July wasn't great for China. They dipped into deflation, faced slowing exports, had issues with youth jobs, and their property market's been lagging. One of their biggest sellers, Country Garden Holdings, is going broke. It's like when your rich neighbors suddenly can't pay their bills. Well, that might be shocking. You might wonder where they got the money in the first place. If they didn't manage it properly, you'd think they got it from a Ponzi scheme or something. This reminds me about my documentary about SBF, Sam Bankman-Fried. Click the card on the screen if you want to hear about that, and if you like special effects. But going back to China, if they default, unless something big happens, the entire Chinese property scene could unravel. And that, well, it's going to hit us like a freight train, taking us back to see something we haven't seen since the crisis of 2008. So hold on to your hats, folks. Asia's once richest woman has lost more wealth than any other billionaire in the world in just over 2 years as her Chinese property development company falls deeper into a debt crisis. She has seen her fortune slump by 84% since its peak in June of 2021, including a drop of 8.2% on Tuesday alone. China Garden's fall from grace underscores how a persistent slump in property prices is weighing on some of China's strongest private builders, once considered relatively immune to the credit crunch. The Foshan-based developer has become a proxy for financial contagion in an industry that accounts for about a quarter of the country's gross domestic product. So here you can see we talked about how demand from outside of China is going down. So that means, of course, factories are slowing down. And that means that workers are not confident because they're looking and they're saying, look, demand's going down and we're seeing few hours being worked. And that means they don't have the confidence to go out and spend money on real estate and other goods and services. So as a result, this Ponzi scheme of a real estate market, and if you're not sure what I'm talking about, because in China, you buy a property and you begin paying on the mortgage, you get financed, you get the mortgage, you begin making payments, and often it's prior to the property even being built. And so what you have is a functional Ponzi scheme that needs a constant supply of new buyers to keep that ball rolling. And what we're seeing now is that Country Gardens, well, they're out of cash and they're about to go bust. And worries about a debt crisis have increased after Country Garden's dollar bondholders said they've yet to receive coupon payments, which is due Monday. That puts the firm on course for its first public default if it doesn't make payments within the 30-day grace period. So what we're seeing is, and we've talked about this in the past, when global trade slows down, what you start to see is the amount of dollars in circulation around the world just starts to decrease. And that means what you're seeing right here, like with Country Gardens, is a global dollar shortage, which is what we're seeing in all the yield curves. We're just seeing that there's not enough dollars to keep the economy going. The next thing you know, this game of musical chairs, when there isn't enough dollars and the music stops and people start looking for them, they can't get them, leaving everybody holding the bag, going into delinquencies and eventually defaults. The problem is, the bigger they are, the harder they fall. The bigger the ramifications are for the global banking system. The profit warning is likely to prelude an ultimate credit event, which could be an understatement, putting us into a global financial crisis. And that might be already in preparation for debt restructuring. And again, up until now, we see no signs of further government support or bailout. We're not seeing a whole lot here, but remember, this is effectively what we did to the US banks. Remember, these small, mid-sized banks that run out of cash, and so we say, no problem. Go to the Fed and borrow it. We'll help you out. Well, here you get to see the potential issue. Oh, you're out of cash? Go get it. Well, maybe the next step is to restructure your debt in the hopes that things turn around. And that's the whole issue. It's hope that in the second half of this year and going into next year, that everything's going to turn around and everybody's going to be okay. The problem will be when it doesn't happen, what's going to happen to the US banking system and what's going to happen to the Chinese real estate market. Well, you're going to see them both blow up. And the problem will be is that US banks are functionally doing the same thing because the Fed has lent them money in the hopes that the economy is turned around. And that's not working either. As we see money market fund assets hit a new record high as banks' usage of emergency Fed funds jumps. So you see the same issue in China. What do you see? Potential bailouts will come. You watch and see. They're going to do it and they'll just go, let's restructure the debt. Let's give you more time. It's the same thing we did to the banks here. And look, it's not getting any better at all. The decoupling between the money market fund inflows and bank deposits continue to diverge. This is as people chase higher interest rates on money markets, leaving banks short of cash. And sure enough, all that translates to, as we noted, uses of the Fed's emergency bank bailout, and that rose by $1.2 billion to a record high of $107 billion. Now remember, if stress in the banking system was going down, if things were getting better, then what you would see is the banks paying back these higher interest rates loans from the Fed and just getting out of the program. Instead, they're still borrowing more. This is telling us that things in the US banks are getting even worse with no sign of a turnaround in the economy to bank on. And here you have US producer price inflation picks up on a boost from services. But are things in the US showing signs of a turnaround? Well, unfortunately, not really that much. And this because the hope is that the services sector was going to lead the manufacturing sector up. And that means that we're going to see producer prices start to elevate as demand comes back. And while we saw a little bit of demand increase in terms of price pressure, we didn't see enough to move the needle. Even though the news thinks so, the producer price index for final demand, which we'll look closer at here, as well as core index, which excludes food and energy, rose by 0.3% in July. And while this came in slightly more than forecasted, downward resistance to the prior month tempered some sort of strength. And here we see again, the issue is that the producer prices are more of a function of the energy sector, as you're about to see. Normalizing global supply chains, tepid demand abroad again. Here's the issue is that there isn't demand, even domestic demand, and a broader shift in consumer spending towards services and away from goods have generally helped alleviate inflationary pressures at the producer level. But that hasn't transmitted yet to the consumer level yet. But headwinds are building up again, look at this, as oil prices climb. And here's the thing I'm going to show you in this next chart, that the increase in oil prices isn't a big deal in the big picture to move the needle a whole lot. If it was, we would see oil prices up into the 90s and $100 a barrel. So you know that crude oil had a little jump recently, right? So some might think that this means they're going to skyrocket soon. Look, especially when you look at this red line here showing yearly changes. But let's not forget, we've seen these jumps before. It doesn't necessarily mean prices will soar and make stuff more expensive for producers. The issue is global demand going to be there? And that's what we're seeing in the producer level, suggesting that perhaps, maybe not. But the issue is, how does this translate to consumer prices? Well, it suggests that even though CPI went up a little bit on a year-over-year rate of change that we saw last week, that the general trend should be lower. And of course, there's also a correlation because we come back to the imports of goods and services. If you have less imports, you need less people because it's a sign that demand is down. Of course, you don't need people, many people working at the ports. You don't need people working in transportation, the warehousing, and even retailers. And sure enough, you see this great relationship as imports go down. You notice the 4-week moving average here in red, it goes up every single time. But what I want to show you is right now, it looks a little different because look at this. It's not happening right now because people don't want to get rid of their labor. They just went out and trained. And China actually bans anyone from mentioning deflation. China's authorities are pressing their local economic experts to keep quiet about any negative vibes in their economy. So things like deflation, capital flight, and dropping prices, they're all off the table for discussion. Several respected economists have been given the hush-hush order. Their goal? Keep the public confident and clueless. One advisor of China's central bank said they wanted us to interpret bad news as positive light. Well, I guess you can see they might have had a series of bad economic reports lately, and it's probably shaking investor trust. They're trying to downplay certain problems like deflation. Even though their price index has been down for months, they're saying, nope, no deflation here. But some Western analysts, like Albert Edwards, aren't buying it. He's been sounding alarms saying that when China clamps down like this, it screams crisis. And with fresh data coming out, there are many expecting China is going to officially announce they're in deflation. But knowing China, they might just say everything is fine. And if they don't, well, I reckon a bunch of Chinese economists might find themselves in hot water. And here's another crazy chart to look at again. Look, the yields are falling as well, but the Fed doesn't get it. You'll notice this is one of those charts again. Why don't you tell me what doesn't look right? And you see every time imports go down, yields go down. Why is that? To spur demand, to spur people to consume. So you see it here again. Yields going down, imports go down. And down, and you see it over and over again. Except now imports are contracting and everyone says yields have to go higher, which is only going to lead to less demand. We have a rough ride ahead of us, indeed we do. Now is the time to cut back, invest if you can. You know, this is going to be a rough time, but we'll pull through it. Try to be as productive as you can so you can make more money. Even if it's for the long term and you don't see any of it now. Try to be as frugal as you possibly can so you don't waste any money on anything that's unnecessary. Try to make sure you possess a bias towards action. Now, what that means is essentially when given a choice to act or not, you tend in favor of acting and ideally acting quickly and decisively. Always focused and strategic on what you have to be doing. This means if you find yourself stuck or stalled and wasting hours, days, weeks, or even months, well, it's time to take a good hard look on what you're doing and the type of actions that you're taking. Because success is going to come from daily actions taken again and again and again, consistently over a long period of time. Like I said, we're going to get through this. Let's plan the next phase of the economy wisely and we'll come out ahead in the years and decades to come. Hey, and don't forget, subscribe to my channel if you're new here and if you like this content, of course. And if you did like it, give it a like and let me know what you think in the comments below.